Good afternoon. My name is Roxanne, and with me I have my classmate Daniel. Today we will go over 2017 CQA Investment Challenge results representing Team Fuqua and Duke-wide University. Last fall, we selected our investment team of students ranging from first and second year MBA students and across different disciplines. We also had the honor of having two investment advisors, Ben Thomason from the Fuqua School of Business and Jim Johnson, our professional advisor. All right, so let's dive into it. In terms of our investment philosophy and process, we focused on identifying factors grounded on investment rationale rather than economic forecasting or fundamental analysis. So we looked at valuation, we looked at quality, we looked at momentum, sentiment, and growth. Again, I want to stress that we looked at targeting alpha factors rather than risk factors. What does this factor research process look like? So first things first, we researched historical factor performance and looked at the investable universe for U.S. large cap stocks that represented over 1,000 stocks with a 1-month holding period. We then looked at 4 different periods ending November 2016, ranging from short-term to long-term. So short-term, 3, 10-year, longer-term, 20, 30-year, on a cross-sectional basis. Then we started doing a deeper dive and looked at C-scores, or rather started taking a look at historical and statistical performance and looked at the different criteria listed. To further delineate, we looked at constructing models that consisted of the top 8 to 16 most consistently impactful factors with overall strong consideration for diversification. We took it a step further, and then we started doing more due diligence and selecting models and rather ranking these models and running back tests with periods of 10, 20, and 30-year periods ending October 2016, as this is the data that is most comprehensive to date. All right, so now let's look at risk and return expectations. And looking at the average decile ranging from on a 1 to 10 spread, or rather looking at overall long-term in-sample tests of U.S. large cap stocks, this is what our model looks like. The model's average monthly results range as follows. For monthly returns, the range is 0.81% to 1.28%. For monthly standard deviation, the range is 2.33% to 3.42%. At the bottom of the page, you'll see that we'll have other criteria, so ranging from hit rate to information ratio. But the moment that you've all been waiting for, we want to understand a deeper dive of what the model factors entail, what the different weightings are, and ultimately how we continue doing due diligence on our factors. So I'm going to pass it over to Daniel, who's going to go into this deep dive.
Thank you, Roxanne. Our model had consisted of 8 factors. These factors were all equally weighted, so each one comprised about 12.5% of the overall portfolio. We had different factor groups. We had a slight tilt towards value, but we did have other factors, including momentum, short sentiment, and historical growth. Looking at how we constructed our portfolio, we broke our stock universe of 1,000 securities into 10 different deciles. We went long the top decile of securities based upon our factor model and shorted the bottom decile of stocks. This resulted in 100 long positions and 100 short positions. We had a beta constraint for our portfolio of between minus 0.25 and plus 0.25, but we did target a beta of 0. We had no additional constraints, so we didn't include or impose sector neutrality on our portfolio. Overall, again, we had equally weighted factors, but we also equally weighted securities within our deciles, so we didn't over or underweight individual securities. And finally, in terms of trading, we rebalanced our portfolio monthly, which was a reflection of the fact that we regressed our returns on a monthly return basis. We only entered or exited positions. We didn't rebalance to equal weighting each month, and this was partly a consideration of trading costs and trying to optimize after trading cost returns. Looking at our sector weightings, we had significant over and underweights relative to sector neutrality. So looking at just 2, real estate was a significant short at minus 25%. Looking at financials, it was a significant long at over 25 to 30%. These both significantly impacted our portfolio's performance and added a bit of risk to our performance. This was not the byproduct of researching industries. It was merely the application of our factor model onto the securities that we were provided with. Looking at our portfolio performance, we compared our returns to T-bills. This was our proxy for cash. If you look at our absolute and relative returns for both November and December, you'll see that they were negative. However, turning to January, our performance started to improve, and February through February 13th was a significantly stronger period for us. Cumulatively, our return is now positive, and we have a Sharpe ratio of about 0.06, but with a maximum drawdown of 3.28, which largely reflects the volatility that's shown in the growth of $1 million. So although we've outperformed T-bills on a relative basis, we've done so with significant volatility. Looking at our attribution, we had significant stock-specific return relative to cash of minus 0.75. Now, looking at our factor attribution, we had style and sector returns that were 0.6 and minus 0.23 respectively. We did not have any market return, largely due to the beta constraint of 0. And overall, our return was minus 0.37, which you'll note is different than the previous slide. We ran this attribution through February 6th. Additionally, Axioma provided additional style-based factor attribution. So on the left-hand side of the slide, you'll see different styles. The top two contributors were earnings yield and market sensitivity, which added about 0.8% to return, whereas leverage and volatility detracted about minus 0.6 return. Overall factor style added to our overall return, contributing 0.6% of our total return, whereas our sector contribution was negative at minus 0.23%. The largest contributor, not unsurprisingly, was financials, which was a significant outweight for us, and real estate and IT, which were the two largest shorts, were about minus 0.5 in terms of performance. Looking at additional items, there are a few things we'd like to do going forward in terms of optimizing our model and improving our portfolio performance and reducing volatility. The first thing we'd like to do is increase our use of out-of-sample backtesting and introduce this out-of-sample backtesting as a way to increase the robustness of our model and ensure that our model reflects not just historical overfitting, but other samples that we did not include in the regression. We'd also want to explore sector neutrality as an additional constraint. As we noted with our attribution, that was a negative return factor, and it introduced much of the volatility that our portfolio had. So we'd like to see what impact that would have on our model and our factor performance. We would also consider removing both REITs and utilities, partly due to the fact that our model was very free cash flow focused in some respects, and free cash flow isn't necessarily a good proxy to use for both REITs and utilities due to a number of concerns. We'd also look at optimizing our factor weights. We use 12.5% equal weightings for each factor. However, we could consider using the z-scores and the information coefficients associated with each factor in order to optimize our return based upon our strongest conviction factor weightings. Finally, we did assess multicollinearity and correlation between factors to a degree, but we'd like to potentially increase the amount that we focus on that and really introduce efforts to reduce redundancy within factors and between factors. Finally, Roxanne and I would like to thank you all for your time. We'd also like to thank our academic advisors, Ben Thomason and Jim Johnson, and we'd like to thank you again for all of your time and your help.
Thank you again. We look forward to participating next year.